Most investors buy covered call ETFs because they think it's the easiest way to generate income. And to be fair, they are easy. But what most people don't fully understand is that convenience comes with a trade-off. And if you don't understand that trade-off, you may be giving up a lot more than you realize. I actually started with covered call ETFs myself. At the time, they were a great way for me to participate in income strategies without really knowing how to run covered calls on my own. So I'm not against these products at all. In fact, I think they absolutely have a place. The biggest mistake people make with covered call ETFs is assuming the distribution yield is the same as their real return. It's not. If an ETF is paying high distribution, but the share price is falling, your total result may look very different than the yield number that got your attention in the first place. And then the market changed, and things started moving fast. The ETF I was in started dropping quicker than I expected, and at the time, I just didn't react fast enough. By the time I realized what was happening, I was already down about 50%. And even though I was still collecting income, my portfolio was still going down. And that's when it finally clicked for me. I needed more control over my positions. I couldn't just sit there and let everything run on autopilot. I needed to be able to decide when to enter, when to take profits, and honestly, when to step back. That's the biggest advantage of doing covered calls yourself. You control the strategy. You could wait for the better day to enter. You control the strike price. You could take profits early or stay patient when the setup makes sense. Now, that doesn't mean covered calls are all bad. I still think they have a place. For people who want income right now, or for people who simply don't want to manage the positions themselves, they can make a lot of sense. You just need to understand what you're giving up in exchange for that simplicity. And that's really the point of this whole video. Not to tell you to never use these ETFs, but to make sure you understand the trade-offs before you buy them. Because if you only focus on the yield and ignore the total return, you may be walking into something you don't fully understand. Covered call ETFs can be a great place to start, but they don't have to be where you stay. If you're willing to learn a simple strategy, you can create income yourself with more control over the outcome. And that's where we're going next. And at the end of the day, this really comes down to understanding what you're actually doing. Covered call ETFs can be a great tool, but they're not magic. You're making a trade. You're choosing income over some level of control and potential upside. And there's nothing wrong with that as long as you understand it. So for me, once I went through that experience, I realized I wanted more control over my outcomes. And that's what led me to start doing covered calls myself. So whether you choose ETFs or decide to learn the strategy, just make sure you're making the decision on purpose, not just because the yield looks great. So I thank you for participating in this shorter version of my videos, and I hope that I showed you something that you can remember and will help you in the future. Thank you for listening. Like, share, comment. I appreciate you all. Take care.